Okay, thank you, Ryan. It's a pleasure to have you all with us this evening for tonight's webinar entitled Staying the Course in a Time of Upheaval, What to Do Now. My name is Jason Doss, and I'm the moderator of tonight's event. I'm an Atlanta-based attorney with the Doss firm, and for the last 18 years or so, my practice has focused on representing individual investors nationwide to try and recover investment losses resulting from investment fraud and bad investment advice and recommendations. I am the current president of the PIABA Foundation, which is a nonprofit organization devoted to preventing investment abuse through investor education. I'm also the current president of the Alliance for Investor Education, also known as AIE. For your information, AIE was founded in 1996, and our organization provides investors with access to a full range of information that's needed to make wise investment decisions. We're also dedicated to working with our members, some of whom are participating as speakers on tonight's panel, including AAII. Our members often collaborate on joint investor education projects like tonight's event because we believe that when we all work together, we can create material for investors that offers solutions from multiple viewpoints, which provides which proves to be stronger and more effective. I want to thank AAII for co-sponsoring this event tonight and for providing access to their webinar platform. You may download the presentation and some additional investor education materials, such as our COVID-19 investor support resources and 10 best resources for understanding expenses and fees. These documents feature resources from our current Alliance members, and you will find all three of the PDFs available to download here with the GoToWebinar dashboard. And you may also follow AIE on social media and use the hashtag AIE Town Hall when posting about this webinar. To learn more about the Alliance, please visit investoreducation.org. Finally, tonight's event has a rich panel of experts, and they have valuable information to share with you. Our speakers include Charles Rothblatt and with AAII, Nuala Zaharis of IPT, Christine Kiefer with FINRA, and Lynn Egan with NASAA. Panelists tonight will be addressing critical investment and retirement strategies to avoid financial upheaval while coming out of this pandemic. What is especially unique with our panel is that each of our experts tonight will address their topics with different lenses on investor education and protection. And it's our hope that hearing their different viewpoints and their different perspectives and the material that they have in a single event will result in a more robust and actionable takeaway for you. So, during their presentations, you may submit your questions through the dashboard so we can address them with our panel members during the second half of tonight's event. So, without further ado, let me introduce our first speaker, Charles Rothblatt. Charles is the Vice President and Financial Analyst at AAII. He is the editor of the AAII Journal, created VMQ Stocks, co-created AAII Dividend Investing, helps manage the Stock Superstars Report portfolio, and authors the weekly AAII Investor Update email. Charles regularly speaks to the media and is a Wall Street Journal expert panelist. His book, Better Good Than Lucky, How Savvy Investors Create Fortune with the Risk-Reward Ratio, was published in 2010. So, Charles, my question for you is, in times like this, why should investors not focus on the short-term moves of the market?
Well, the answer is simple. The odds are really good if you actually sit and just don't do anything with your portfolio. When you watch the day-to-day news, you hear about the Dow reaching a new high, or perhaps on a bad day, the NASDAQ falling, and you're always hearing this constant news. There's always this urgency that you have to act. And the reality is, if you lean more towards, say, Warren Buffett than many of the people shouting on TV, you'll have better success. Over any 5-year period since the late 1920s, your odds of losing money over a 5-year period in stocks is just 14%. If you go out to 10 years, and large cap stocks is less than 5%. Now, does that mean you'll get the best returns? No, but if you go beyond a 5-year period, your odds of losing money actually drop a lot. And you can see in the chart in front of me, the first chart was actually showing the spread of returns over a 1-year period. Pretty big range of returns, from down 43% to up 54%. So in any one single calendar year, you can have a wide range of outcomes. But then if we go out to 5 years, and the range of returns actually narrows. And you can notice the bars. This is a histogram. So the higher the bar, the larger the data in a particular subset. So most returns over 5-year periods, the annualized returns is in a range of 7 to 21%. So not only is it positive, it's positive in a good manner, positive in excess of inflation. Now, does that mean that every 5-year period you're going to make money? No, but it's been very few 5-year periods where investors have lost money over 5-year periods, and those include the Great Depression. So if you just sit and ignore the headlines and have a little patience, you'll do fine. Now, if you're nervous and you're thinking, well, I don't have 5 years, well, that's why you have cash, and you hold cash to get you over the short term, to get you over the bumps in the road. But even though people might be worried about the coronavirus, the election, the reality is if you just look past that, you're actually going to find out that your odds of success are going to be pretty good. So what can you do in the situation right now where you're hearing me saying, yes, I understand long-term odds, but I'm nervous now? Well, there's a few things you can do. One of those things is just to think about, why are you investing? What are your goals? And what's the timing of those goals? If your desire is to buy a new house or maybe a new car in the next few years, then you absolutely should not be in the market. But if you're thinking about funding retirement, you're thinking maybe about a grandkid's or a young child's college, well, then there's an argument to be in stocks if you have a long time horizon. So stop thinking about what's going to happen over the next 3 to 6 months and start thinking about, why is money important? What am I investing for? What is that goal? And keep that goal in mind. The next thing is, afterwards, once you have a goal, then you can start thinking about your asset allocation strategy. What you see in front of us is our moderate allocation strategy. We've tweaked it. It's basically a 60% stocks, 40% bonds and cash strategy. And the idea is your allocation should be tied to your goals. So if your goals are shorter term, your allocation should be more conservative. If your goals are longer term, say you were just retired or nearing retirement, you could be looking at a lifespan of another 20 or 30 years. So you should be thinking long term with a large portion of your portfolio. So figure out what you're investing for and then adjust your allocation for those goals versus trying to react to day by day headlines. Now, the other thing you can do if you're nervous has to do with savings. Chances are many of you, like me, you're going out less, you're eating out less, you're not going to live events. Perhaps you're going to Starbucks less. It means you're probably seeing more money in your savings account. That's good. Get in the habit of saving money. And if you're in that age range of 40 to 50 years old, or maybe 60, and you're seeing retirement get closer and closer and you're worried about not having enough, try to save more. In fact, as you get closer to retirement, the amount you save will have a bigger impact on your retirement success than your returns will be. That's because you have a lower time period till you get to retirement. So the more you can save, the better you can do. And from a control standpoint, we cannot control what Mr. Market does on a day-by-day basis, but we can control how much we can save. And so it's something you can do positive for yourself, something you can channel your emotions, something you have control over. Now, what if you're retired and you're nervous about the market? Well, Vanguard's done the research into it, and go to next slide, please, Whitney. They found out that if you're retired and you're taking withdrawals, the more you can tighten your belt during hard times, the greater your odds of success will be. So if you're nervous about the market, consider about withdrawing less. Now, you will have this required minimum distributions that you're required to take out of your traditional IRAs, your 401ks, and similar type of accounts. But the IRS, nowhere in the tax code does it says you have to spend the money. You just have to take it out of your account. So take that excess money and put in savings. And I realize certain people, they can only time so much, and that's understandable. But the more flexibility you have on not spending as much as you'd like to out of your retirement savings, the greater your odds are going to be of success. Now, on the flip side, if you're retired and you get to about year 5 or 10 in retirement and you start realizing that your assets are far greater than you projected, then you have flexibility in the upside to spend a little bit more. So it does work both ways, but where you have the most success is not limiting your spending on the upside as much as your ability to time your belt when you get nervous or you see the markets going down. Now, finally, I know Lynn later in the presentation will give some suggestions for protecting yourself online and protecting yourself from scammers. But the other thing you can do is just practice good cybersecurity. In the July issue, we have an article about protecting yourself online. We're talking about phishing attempts, talking about passwords. I personally use a password manager. It's Dashlane, which you see on your screen. LastPass is a very popular alternative. We have those in the article, but a very simple step you can do is just vary your passwords. And for every financial account you have, just use a different password and make it nonsensical. Have words and letters that maybe make sense to you. Perhaps it's, picnics in December 22 dash, or something just odd like that that means a lot to you but not to a criminal, and vary it for every account. So if one account does get hacked, the scammers only have access to one account and not everything. Jason, back to you. Thank you for the opportunity.
No, thank you very much, Charles. So our next speaker tonight is Nuala Zaharis of Investor Protection Trust, or IPT for short. Nuala is the director of the Georgia Secretary of State's Securities and Charities Division, a position that she has held since 2014, and she's on the board of trustees for the Investor Protection Trust, which is a nonprofit organization devoted to investor education. And she's on the board of the National Association of State Charities Officials, or NASCO. Nuala, I know you're going to talk about retirement planning. Can you discuss what investors can do at different stages of their life to prepare for retirement, and how the When I'm 65 program that IPT puts on can help?
Yes, and thank you for having me today or tonight. And I need to say my disclaimer that anything that I say today does not represent or reflect the views of the Georgia Secretary of State. So having said that, I wanted to talk a little bit about the Investor Protection Trust and a program, several programs that it has. So the Investor Protection Trust is a nonprofit organization that is devoted to investor education. It was established in 1993, and it works with state regulators and other organizations, but primarily with the state securities regulators on providing educational tools and programs for the citizens in their state. So I love this foundation. One of the programs that it has is a program called When I'm 65. So I want to stop and tell the younger investors that are listening here that don't let the term when I'm 65 turn you off, because I'm here to tell you that you may be 25 right now, but one day 65 comes a lot quicker than you think it comes. So it really doesn't matter what age you are or what stage you are in your life when you're trying to grow your wealth. What matters is that you do something about it, that you have to start, and starting early, the earlier the better. So When I'm 65 is a national documentary program that also has addresses the different stages of investing in about, I think, 4 or 5 different stages, which we'll go through. And each one is very, very good. Out of another program that we have, and it really came out of the When I'm 65, is a program called SHELEADS. And this program is really targeted for women and helping women realize how to mitigate their risks, the challenges that they have, in accumulating wealth, and you know, doing more financial literacy. So if we can get to the next, that would be great. Thank you. So the When I'm 65 is broken down into different, you know, stages of life. So the first stage is the managing your money when you're starting out. The second one is to start saving for retirement. Then at a certain age, you have to ramp up your savings for retirement. Then you're getting closer to retirement, and then you're making your money last while you're in retirement. So if we could go into the next slide, thank you. So this is the first one, the first stage. As you see, the When I'm 65, there is a documentary which you can watch on the Investor Protection Trust website, and these booklets that we have are also on the website. And I really highly suggest the documentary. It's very, very good. It really walks you through the different stages. But at the first stage is ages 16 to 24. A lot of young people really don't think about, you know, saving their money. I think it's a time when they're getting their first paychecks, and you know, you get that first wad of cash, and you're like, oh my gosh, you know, I'm going to go buy that great pair of shoes, or you know, that, you know, I'm definitely not going to put it in a savings account. So, but you got to start thinking now. So this booklet, this program takes you through different steps that young investors need to think about. And it's to start saving and now. And everyone knows that the earlier the better. You know, building your wealth does not come quick and easy. It happens, you know, it's sustained. It happens over a long period of time. So when you're at this stage, you would, you know, just start saving. You need to file your first tax return. I believe that there is that if you're single in 2020, you have to refile your annual return if you make $12,400 or more a year. You should still file it if you do not. You should consider putting, if you get a refund, put that into savings. You need to be smart about student loans. This is an age where, you know, you're going to different colleges, so they're throwing all these different types of loans at you. You need to do your research on the loans. Make sure you know what you're getting into, and know the terms, know how much you're going to get paid, know what you have to pay back, and any penalties there. Another thing is to start off right with credit and debt. Can't say that, you know, I can't impress that on my children. You know, credit cards, if you can learn how to manage them, will help you build a good credit, but they're very quick to, you know, you can get in trouble with them very quickly. So if you are in a situation with credit cards, you know, you got to pay it on time. You can't, you know, don't charge more than what you can pay off immediately, because what happens is if you just pay off the minimum balances, we all know that interest accrues and it just balloons into something bigger. If you're at a point where you can open a Roth RIA, do it and become an investor. Even if it's a little bit of money, you put it away and it will grow. The next slide, please. So you've gotten out of college, you're getting your first job, you know, you've got a first paycheck, maybe you're getting to your second job. So you're starting to think about saving for retirement. So this booklet has information on the steps that you can take while you're in this stage of your life. So here it says that you should start saving what you can today to give your money maximum time to grow. Yes, as we said, each one has a premise. The earlier you start, the more you'll save and accumulate. So you should learn what retirement savings are options. You could, if your employer may have a plan, you may want to open an RIA, whether it's traditional or Roth. You may want to, if you're self-employed, you may want to, explore things, things that are out there for you. You want to choose investment based on your timeline and your risk tolerance. So as you grow in the different stages, your risk tolerance and your timeline will change. So at this stage, you work real hard to see that your investments are probably diversified and you understand exactly what you're getting into. If you don't know, don't understand the product, don't understand the investment, ask questions. Find out the details. You still don't understand it, ask again. If you still don't understand it, maybe it's not for you because there are other things out there for you. The final thing would be is to select a financial advisor to guide you along the way. There are a lot of people out there who are providing advice. There are people who work for as broker-dealer agents, for broker-dealers, through FINRA. There are the investment advisors out there. Those are people who actually will give you advice on your entire, financial portfolio. They're out there for you as well. There are people who are certified financial planners, certified financial analysts. Be careful with, there are a lot of people who have different designations, and so make sure you research the designations. So select a financial advisor that you will work with you, that's more comfortable with you. Don't pick one because your friend told you that, oh, this person's good, because that person might be good for your friend, but that person may not be good for you. So it's very good to make sure that you do your research, to find an individual to help guide you, to give you the advice and steer you in the right direction. The next slide, please. Thank you. So now you're at ages 40 to 55. So you're here to start ramping up your savings because you're starting to think about retirement. At this stage, you are, you're trying to boost your savings to supercharge asset growth. Let's see. What you want to do is, reassess your investments based on your timeline. You're at a different time in your period, so you have to reassess your investments, your timeline, your risk level. You want to make sure that the financial advice that you get is very dependable. Someone that is, understands, where you are at this time to help you, grow it during that period. You also want to maximize your social security. This is a time where you want to start researching it. Make sure that do your research to see when you can take it, how to take it, and also it's a time where you should determine, okay, when do I really want to retire? Because that's going to help you decide, how you're going to, keep growing in your investments. Next slide, please. So now we're getting closer to retirement, and here, this is the stage in life where you'll want to shift your investments, focus from growth to wealth preservation. So at this point, you're probably going to think about withdrawal strategies when you start taking money out and or start receiving pension payments. And if you think about withdrawing, you got to start thinking about the tax implications to that. So you need to think strategically at that point. You might want to you should get trustworthy advice to stay on track. So at this stage, financial planning gets a little more complex as you approach retirement. So you may need additional professional guidance on that. You should get familiar with the Social Security and Medicare rules. Plan for that. With Social Security, the longer you postpone taking the benefits, the amount you finally take may increase. Take a look at Medicare. I believe Medicare Part A is that no charge at a certain age, and then later Medicare, you can think about Medicare Part B. At 65, since Medicare Part A is at no charge, you might want to think about signing up for it. And then do your research. Look at the pros and cons. Understand what's good for you. For example, annuities. There are annuity products are out there. I can't speak on annuities because I don't understand them, so I stay away from them. But if you are interested in something like that, you should really do your research, not just on that product, but on any product. And if you don't understand it, don't invest in it. Then get more value from your home equity. Sometimes at this stage in our lives, we are home alone. Everyone is gone. It's an empty nest. So is it time to downsize? Is your home your biggest source of wealth? Take a look at that. And you might finally want to explore a phased retirement. For example, maybe instead of working, full time, I can do, be semi-retired and still work. So these are things that the booklet will and the program, have that can, help you walk through that. Can you go to the next slide, please? I think the next slide, is there one? Yes. Okay. So finally, you're managing your money in retirement. You're 70 and up. So here you are, you need to identify the different sources of income that you have, at this time. You need to understand the rules for required minimum distributions. If you can, you should stay engaged in the workplace. Make sure that you're spending your savings safely, manage the Medicare wisely. If you need, the advice, make sure you get advice that's trustworthy for your age, and consider your location. Again, that is like, where are you? Are you still in your home? Do you need to downsize? Do you want, where do you need to, how can you, help get through this phase in your life? And then the next slide, please. So SHELEADS, Women in Investing. So SHELEADS started, Georgia did the When I'm 65 program. And at that program, we had 70% of the attendees were women. And they were there to talk about, saving and investing. So as part of that program, before we had it, we did a survey of 1,200 Georgians, and we found, these statistics that the Georgians did not have sufficient retirement planning or even education or knowledge about how to save and plan for retirement. We found that 42% of Georgia residents believed that they weren't adequately contributing to their retirement accounts. 28 of the respondents did not have a retirement plan in place because they felt like they didn't have enough money to do that. 44% of the women respondents told us that they weren't currently planning for retirement. And over 50% of African American respondents don't feel they have enough information to make investments in retirement. This is what we took away. But at that program, on that night in September, 70% of the attendees were women, and they were talking financial security, and they really wanted to get more information about, how can they as women, be more empowered because they have so many challenges. The investing is the same no matter what gender, but as women, they had unique challenges. So we started a program in Georgia that was kind of dovetailed off the When I'm 65, that was designed to engage and educate and encourage and empower women. So we have these programs where we have panelists and people who talk about every aspect and every stage of planning for the future. And so they have been very well received, very popular, and we keep them very grassroots, meaning that we have these, when we have them in person, they're in the community, the people, the women who are leading it are from the community. They're women leadership in the community, in the financial space, because it's, you'll trust someone from your community, than bringing in an outsider. So we found that, again, the challenges maybe different for women, but the issues are still the same. They're looking for ways, to save and plan for the future. And the next slide, I believe. Yes. So as I said, the program, I do encourage investors to go to the Investor Protection Trust website and look at the When I'm 65 series. The booklets are very, very good. I have them here. They're actually very informative, and the video is great as well. So anything that you can do to educate yourself it will empower you, will help you, steer you to the right place, and never ever forget to ask questions. Thank you.
Thank you so much, Nuala. So Before we go to the next speaker, there's over 500 attendees on this call, on this webinar. So, if you have any questions, feel free to post them. I'm kind of going through, there's quite a few, and I'm trying to pick. If I don't end up asking your question, I apologize, but there's only so much time. But if you have questions, ask it on the panel, and I'll try to get to it. So our next speaker is Christine Kiefer with the Financial Industry Regulatory Authority, also known as the acronym FINRA. Christine is Senior Director of FINRA's Office of Investor Education. In this role, she develops tools and programs for law enforcement, advocates, and consumers to advance investor protection and fraud prevention initiatives. Christine also directs research into the prevalence, mechanics, and consequences of financial fraud and oversees financial readiness programs supporting military families. So Christine, I know that FINRA and the FINRA Foundation do a lot of great research on investing, and can you share some tips that investors on this call should be thinking about when it comes to managing their money?
Absolutely, and thank you for having me this evening. Next slide, please. Just to level set briefly, FINRA is the Financial Industry Regulatory Authority. FINRA regulates all brokers and brokerage firms in the country. We work alongside the Securities and Exchange Commission and the state securities regulators, including Lynn and Nuala here on the panel this evening. And FINRA's mission is dual, and it's investor protection and market integrity. And you as retail investors are the investing public that we're really looking to protect in this capacity. The FINRA Investor Education Foundation supports a lot of community outreach and education initiatives with public libraries and a lot of nonprofits around the country. And we also engage in a number of research studies, which is what I'm going to talk a little bit about tonight, but I promise not to bore you with academic statistics. Next slide, please. Just to level set a little bit more, when we think about investing and when we think about emotions and biases that we bring to sort of all sorts of decisions, we know that there's always biases that cloud our judgment. But when we look at investing in particular, you can see why it's a very emotional thing, and we can often be clouded by our biases and sort of, buy at the wrong time, sell at the wrong time, making emotional decisions. And the research tells us that biases are most strong when information is complex, when there's a lot of risk and uncertainty, when we desire a positive outcome. So we're really looking for that return. We're looking for the upside, not the downside. And when there's some conflicting priority, for instance, what's better in the short term versus the long term. And this is actually coming out of other academic research, but it really fits the investing framework. And we think about what's happening in today's environment. We certainly must agree that there's a lot of risk, uncertainty, desire for positivity, complexity, and conflicting priorities. So we need to be attuned to our emotions and the biases that are most prevalent for us right now. Next slide, please. So as very active investors of AAII and the Alliance for Investor Education, you already know these keys, but I'm just going to remind you very briefly. Go ahead and advance all of the animations on this. Remember, you need to know yourself as an investor. And I know that's the basic principle of saving and investing, is knowing yourself. But those biases come into play, and we sometimes misjudge who we think we are when we misjudge our risk tolerance. And I'm going to get to that in a minute. We need to embrace diversification now more than ever. And we need to be, Charles mentioned this, we really be thinking in years, not hours, not days. This is a long game. Maybe your investment time horizon is different than someone else's, but there's still some perspective that you need to take as you manage your portfolio as to how long each pocket of that money really needs to last. Next slide. So to tell you a quick story to talk about risk. This is my 13-year-old son, so I'm allowed to show this photo because I signed my own release. And this is my son when he was 13, not long ago. And he loves roller coasters. And he, doesn't really, in all actuality, he is that impulsive, kid and always has been, and he loves risk, and he's just going for it. You can see the big smile, and this is actually technically our second ride on this roller coaster. Mom did ride with him, and yes, that was the front row. Now, he knew when he got in that front row how he felt about risk. He thought he knew. And everybody, we waited 45 minutes for this roller coaster. And everybody that was lined up had waited 45 minutes for this roller coaster and was all anticipating the ride. You can see right there, this is actually the ride we were on. It's a straight down. We were looking forward to this ride. But in the moment of the ride, if you've ever been on a roller coaster, most of you probably have, they always take that picture. And I think of the picture on the roller coaster as the perfect example of how you really feel about risk. So how do you feel about risk? Well, here we are. Now remember, all of us waited 45 minutes for the roller coaster. Now my son in the front row with me is pretty happy. He is not regretting his decision. He's really glad we're in the front row. I'm next to him, and I'll come back to me in a second. I'm doing okay. I don't ever put my hands up, but I'm enjoying myself. I've got a smug smile there. The woman behind my son, however, is very much regretting her decision. She's not sure that she calculated her risk properly, her risk tolerance properly. And the fella next to her is somewhat of an older version of my son, can't get enough of the risk. And the people behind them, again, starting to be a little more fearful. And the reason I'm doing okay is if you look closely, I've got my arms clasped because I feel my safety. I feel the sense of the restraints. And diversification is the perfect restraint. Diversification is a way that we can, take the risk, but also have a sense of safety. And so as you're evaluating your risk tolerance, I want you to think about, what do I look like when I'm on the roller coaster, not when I'm in line. Next slide. So very quickly, with the tips that Jason knew I was going to bring this evening, Charles has already mentioned, and Nuala mentioned as well, and I know Lynn will too. Revisiting your financial goals and plans is top of mind for everybody. It's not a set it and forget it. We need to consistently revisit them. Our situations change. A lot of people are facing unemployment or changed employment. Maybe some of you are seeing excess savings, as Charles referenced, right now. And how can you take advantage of that? So I encourage you to continue to reevaluate your goals and plans, but at the outset, make sure you're buffering that emergency fund as much now as ever. If you have the opportunity, if you are seeing excess cash flow right now or excess savings right now, make sure that you're buffering up your emergency fund as well. But check your emotions at the door. Slow down your decision making and really try your best to think about what those goals are, and let's ground in those goals, and let's make sure my portfolio is diversified appropriately, that I don't need to react emotionally to that roller coaster downturn. Be very honest about your risk tolerance. I already said that. Think about your areas of liquidity. Are you engaging in margin? Is this really something you're comfortable with? Is there a potential margin call that you're not predicting, you're not anticipating? And protect your money. Be thinking carefully about wills, estates, revisit your beneficiaries. I'm going to get to trusted contact in just a minute, and be alert to the red flags of fraud. And Lynn's going to talk quite a bit about that. Next slide, please. And as we get into fraud, just to step back with some FINRA Foundation research, we partnered with the Better Business Bureau, Institute for Marketplace Trust, and Stanford Center on Longevity to look at victims, people that had reported being approached for scams. Not everyone fell victim, but some people were victimized and some were not. We wanted to see what some of those differentiating factors were. And it really does play out that social isolation increases fraud risk. So we need to think carefully about the environment we're in. Again, right now, can you advance? Thank you. The environment we're in right now, where we are isolated to some degree, maybe not as much through these Zoom types of platforms, but there is a sense of isolation. How can you break through that isolation, have more frequent contact, maybe with your financial professional, or have more frequent contact with your loved ones? And it really can make a difference. Next slide. And so our formula coming out of the research for fraud prevention is asking for input from others. I know all of the panelists here would agree that, making sure that they're verifying information, that you're looking outside of just that single point of pitch. To ask for input from others can make a huge difference. Focusing on your health and literacy, times of financial instability are also vulnerability points. So I encourage you to think carefully about what your debt load is, where your vulnerability points are, and be realistic. And get to know as much as you can about the scams and frauds that are out there so that you can recognize them and help protect others. And Lynn's going to share those wonderful tips with you. Next slide. Very quickly on trusted contact, I mentioned it as far as something you should consider. FINRA passed a rule, or enhanced one of our rules, to require firms to attempt to collect an alternate contact on accounts. And what that means, it's not a power of attorney. It is not a beneficiary necessarily. It doesn't have to be the same person. It's not anyone that has transactional authority on your account. It's just someone that they can reach out to if they suspect financial exploitation or suspect diminished capacity or some other reason why, or they aren't able to reach you for an extended period of time unexpectedly. So it's just a backstop. It's just a call, and we encourage you to take advantage of this when you can, when your firms ask. Next slide. I'm going to finish up very, very quickly with just a couple of reminders that FINRA has a lot of great tools and resources, investor education. We have a broker check as a tool to check the background and disciplinary records of registered brokers, and it connects to the investment advisor database as well. So we encourage you to check that out if you haven't already. Next slide, please. Oh, there's my animation. There's broker check. A couple of tools that are, we have a 401k saved to the max calculator, but a professional designations database, a fund analyzer where you can analyze different funds and fund families, 18,000 of them, as a matter of fact, fed through Morningstar data, and really do a cross comparison with charts, graphs, and downloadable data to see where those fees may be eating away at your potential returns. Next slide. And lastly, I encourage you to sign up for our investor alerts and all of our investor insights. If you do have any problems, we welcome calls, or even if you just have a question, you're not sure about something, we welcome a call to our securities helpline. You don't have to be a senior, but if you are, they're especially there for you, but they'll answer the phone from anyone from 17 to 107. So I think anybody qualifies. Jason, I think I'll pass it back to you.
Okay, thank you so much. So our next and final speaker is Lynn Egan with the North America Securities Administrators Association, or NASAA. Lynn is the Deputy Securities Commissioner for the Montana Commissioner of Securities and Insurance. She's currently the chairperson for the NASAA Investor Education Section, the NASAA State Legislation Committee, and has served as the chairperson for the NASAA Committee on Senior Issues in Diminished Capacity. Lynn is also a trustee for the Investor Protection Trust. So Lynn, what information can you share with us about current trends in investment fraud going on right now, and how COVID-19 is affecting investor protection measures among state regulators?
Certainly, and thank you again for having me on this webcast. It's great to share this information. While the world focuses on COVID-19 pandemic, fraudsters are busy peddling miracle cures or innovative technologies, and they're preying on unsuspecting investors. Investors need to be wary when they see on the internet or on social media claims of companies raising money promising new healthcare products that can treat, cure, or detect coronavirus. With coronavirus-related investment opportunities, investors need to be especially careful and proceed with caution for numerous reasons. The promoter can never be certain how much product it'll produce, if any, or if the product will even be effective. The promoter usually has little or no experience with the healthcare or medical equipment field. This is a new and novel way to lure investors. Most of the COVID-related investments out there are not registered. They're private offerings, which means investors are not seeing the information the public would see, and the products are not don't have oversight on behalf of state or federal securities regulators. While the investment may be legitimate, any revenues realized may be negated by fees or expenses skimmed off by the promoter. And finally, many of the investment opportunities related to COVID that we've seen as state and provincial regulators are just out and out scams. So investors can protect themselves from COVID and other types of scams. First, number one rule, don't invest money that you can't afford to lose. Secondly, do research. Ask lots of questions about the risks and the fees involved. Use the broker check opportunity that Christine just talked about to see if the person offering the product to you is properly registered. Check and see if the product is properly registered. Lots of these things are fake. Don't fall for sales techniques that include repeated phone calls, cold calls, emails, and high-pressure sales pitches. They're just trying to hype the profitability of the deal and promising a sure thing when oftentimes, most often, it's not. But before investing in anything, call your state, your provincial, or FINRA and check on who it is that's offering and whether the broker-dealer firm is properly registered. Next slide. Be careful of fraudsters and bad actors targeting your retirement savings. The CARES Act provides significant relief for businesses and individuals affected by COVID, the pandemic. Retirement investors affected by the virus as a result of the CARES Act can gain access to up to $100,000 of their retirement savings without being subject to early withdrawal penalties and with an expanded window for paying income tax that they would owe on the withdrawal. Additionally, the Act allows qualified individuals impacted by the pandemic to pay back funds withdrawn over a 3-year period without having the amounts recognized for income tax purposes. Additionally, the Act doubles the ordinary retirement plan loan limits for qualified investors to the lesser of $100,000 or 100% of the participant's vested account balance with a 5-year payback window. We have seen, unfortunately, unscrupulous promoters encouraging people to make these withdrawals and invest the money in high-risk investment opportunities. The CARES Act provided this type of relief for that purpose, relief. It didn't provide it for scamsters to make money off the investment. By doing so, by taking your money out of these accounts and putting them into the market, you probably will be paying higher fees. You might buy investments that are difficult or costly to get out of at the time you need to pay back the funds to your qualified plan. You'll lose out on the compounding of the money in your retirement account by reducing the balance. And you may significantly increase your risk if you're investing in high-risk funds and high-risk investments using borrowed funds. Again, the CARES Act was designed to address hardships, not increase investment options. Next slide. Christine talked about social isolation, and I'm going to just expand a little bit on how social isolation is exponentially ramping up senior exploitation. Social isolation has long been a leading factor contributing to financial exploitation of older investors. This unprecedented quarantine, again, has caused a lot of seniors to lose a lot of money. While financial abuse can happen anytime, perpetrators often strike at times when a senior's life, when they're more vulnerable, such as during a health crisis or the loss of a loved one. And currently, nearly every senior is isolated, and this is one of the biggest crises we've seen in the last 100 years. The way to protect a senior at times like this, if you are a senior, ask for help anytime anybody asks you to invest money. Involve your family. Involve your friends. Involve your trusted contact, as Christine talked about. Again, focus on your financial health and your literacy. The less financial strain you're under and the more you know about investing, the more likely you won't be susceptible to scammers. And know the scams and the scammers' tactics. You need to learn what the most recent scams are, read the news, see what's happening, and that should reduce the impact of scams. But the number one thing to do is don't be afraid to complain. If somebody's calling you and you haven't expected the call, if somebody's putting high pressure on you, complain to everyone around you. If you don't want to call a regulator, if you don't want to call FINRA or your state, talk to somebody else. People know to pick up the phone. Next slide, please. I guess I'm advanced one too soon. I'll just keep going without, you don't have to go back. Social distancing does not mean social isolation. As Christine said, if you're related to a senior, contact them regularly. Make sure they're okay, ask how they're doing, and ask what they're up to. Inform them on what they need to do to protect themselves. If they aren't active on the internet or don't have access to materials, tell them what's going on. Teach them the red flags of fraud. NASAA just developed a caregiver's care toolkit, which teaches caregivers, nursing home staff, family members, and home health caregivers on how to educate seniors and what to look out for. And again, act. If something seems amiss, call immediately. Okay. During volatile times like these, it is a common thing to do to try to flee from higher risk investors, or what you perceive as a higher risk investment, to something that you perceive as a safer investment. And we previously saw that the market does do well over time. You don't get in it for the short term, you're in it for the long term. But we're seeing, as state regulators, we're seeing people getting out of well-built, well-diversified, long-established portfolios and buying gold, silver, cryptocurrencies, things that they don't understand because somebody touted it as safer than the market. You can protect yourself at times like this. First, take a deep breath. During volatile times, the market may seem scary, but you're on the roller coaster and it'll eventually come to a stop and you'll be alive and well and happy you did it. Talk to your accountant or your attorney before making big changes in your investment portfolio. If you jump out because somebody says the market's not safe, you may have substantial capital gains. You may have consequences you didn't realize were happening. Don't put all your eggs in one basket. Don't sell your securities portfolio to buy gold. You need diversification. It's the best way to hedge against market volatility. Ask questions. Understand the commission charges. We just took out a metals case where the commission was 60%. Somebody investing $100,000 had $60,000 skimmed off the top in commission. Had they asked the question, they may have gotten a fraudulent answer, but had they asked the question and taken notes, we could have used it in our case. Next slide. Next slide. NASAA recently formed a COVID-19 enforcement task force, and it includes more than 100 investigators from 44 jurisdictions, 44 states. To date, and this task force is less than 90 days old, there have been more than 200 distinct actions taken against bad actors operating in COVID-related opportunities. They're out there, they're good, they've got glossy websites, they're showing pictures of vaccines, they're reaching out to people across the country, and again, we're only 90 days in and we've taken 200 actions. What we're seeing is these promoters not only focusing on COVID-related testing, vaccines, equipment, oil and gas ventures, real estate opportunities relating to COVID, penny stocks, precious metals again. Next slide. Next slide. In a Texas matter, we saw this statement: the stock market is crumbling. Profit off the coronavirus with Forex. Forex is complicated. We had seniors jump off a cliff and invest in Forex, only to lose 85% of their investment in a matter of weeks. I'm sure we will identify many, many more frauds involving this current pandemic in the months to come. But our goal is to reach out to people like you, people that are taking the steps to protect themselves, and good job for calling into this call. And we will keep you up to date. There'll be press releases. FINRA will have press releases. We're working together to protect you all. And finally, last slide. Final slide. Is there where to turn? I previously said it. Christine brought it up. Always feel free to contact your state securities regulator. Contact FINRA. Go to broker check. We've got resources for you to report fraud. We've got senior helplines. We've got investor helplines. Every state is on board, ready to help, and willing to do what we can to keep your money safe. And thank you so much.
Thank you so much, Lynn. So now it's time for the question and answer session. If you haven't already done so, please pose your questions within the question panel of the dashboard. If you have a question for a specific panelist, please let me know so I can indicate that when I'm asking it. If you haven't already done it yet, don't forget to follow us on social media using the hashtag AIE Town Hall when posting about this webinar on social media. Other Alliance for Investor Education documents provided for your benefit this evening include the COVID-19 Investor Support resources and the 10 best resources for understanding expenses and fees. You'll find all of them at the GoToWebinar platform. I want to just say something before we go to the question and answer. I want to thank all of our speakers tonight, and I think that you're seeing that everyone here is an expert. They're all talking about what they know, and they're sharing the information with you, and they come at it from different ways. And so as I ask these questions, if any of you have, I may ask a specific question to Charles, but if you have anything you want to add, I'm trying to sort of arrange these questions in a way so everyone can chime in. There was a few questions that came in that seemed to focus on concerns about fixed income investments right now. You know, with interest rates potentially being, negative interest rates, some folks on the call tonight or on the webinar asked questions about the sort of traditional thoughts about investing. For example, the 60-40 concept assumes that bonds have yields that will exceed inflation. And where should fixed income investments be invested today in this time of uncertainty? Put another way, where should you invest your savings if you're looking for a safe cash equivalent that pays more than a bank account does when you're looking to invest your savings during this pandemic? Another part of this question was somebody else. Is it wise to stretch your allocation to put more in equities during this time when interest rates are so low? And would it make sense? On the other hand, someone else asked, would it make sense to reduce stock exposure by 5 to 10% when there's stock market volatility? So it seems like every which way there's risks. What should people do? Charles, I'll start with Charles, and if anyone else wants to chime in, go for it.
Sure. I think this to start off is, I think for everybody, the general rule, the optimal strategy is always the one you can stick with no matter what the market's doing. So it's not the strategy that maximizes your yield or maximizes your return. It's the one you can stick with. And in this environment, people are right. The interest rate environment is very challenging, but there's an old adage that bonds give you the courage to invest in stocks. And over the long term, bonds have really been uncorrelated with stocks. So when stocks zig or zag, bonds might do something completely else. I would say people are concerned about interest rates. There's a few things you could do. Certainly you could go shorter in terms of your duration, going for intermediate term bonds or shorter term bonds. The alternatives, you could ladder bonds. So you're buying bonds of different maturities. If you don't want to own individual bonds, there are vehicles called defined maturity bond funds. We've talked about them in the AI journal. They're actually bond funds that mature on a certain date, and you can buy those at different maturities that kind of spread out your interest rate risk. If people are really worried about interest rates rising, they could look to CDs. But I think the big thing is to realize that bonds are really your cushion against the volatility of stocks. And even though yields are really low, and perhaps you're looking at your interest you're getting right now on your bonds, on your savings accounts, and you're cringing, sometimes you just have to deal with a tough environment and realize there's a bigger reason why you're doing this. Now, for somebody who wants higher interest rates on their savings, I would encourage them to go to look online. You want to make sure the accounts are FDIC insured. If you're going through investments, the SIPC insured, credit unions have backing. We at AAII, we do have a loyalty relationship with Discover. Certainly members can look at that, but realize that the yield looks too good to be true in the current environment. It probably is. It's probably not an investment that's secured by regulators. It's an investment that's taking on excessive risk. And again, the whole idea of bonds is just to really cushion that volatility. So there's still a place in the current market environment, even though yields are much lower than many savers would want them to be.
Jason, I'd add one thing. Charles hit all excellent points when he mentioned the yields. You know, if you see a yield that looks really enticing and is well above market, be particularly have a heightened sense that there might be a bait and switch happening. You might be enticed to come in and have a conversation because you saw an advertisement for a certain yield that will potentially lead to some sort of high pressure sales pitch to get you into a different product. So just be very, very careful that, you know, if we're all looking for above average yield or above market yield, then there must be a catch somewhere along the way when you find something that good.
Okay. Anybody else? Okay, I'll move on to the next question. The next question is, there was some comments about just reminding me that a lot of the AAII members that are on this call really manage their own money. A lot of these people they don't use a financial advisor, they don't trust a financial advisor. So I've got two questions. One related to what people who manage their own money need to think about, and that is, it's not always the financial advisors are the bad guys. Sometimes the issuers of these private placements. A lot of times, I know in my line of work, that's a pretty prevalent problem area. So if someone believes they're a victim of investment fraud about a product, about a company, where should they go? And it's not common that we have, you know, state regulators on the phone on the webinar as well as FINRA all in one nice bow. So Lynn, Christine, Nuala, what should people do if they believe that the company that they've invested in or the investment that they invest in is a fraud?
Well, I'll start. As a state administrator, we get a lot of calls from investors that invested in some kind of a private placement, generally under Regulation D, Rule 506, many times directly with the company and oftentimes through a broker-dealer firm. Contact your state. If there's fraud in the investment, the state has the ability to go after the issuer for misrepresentation, either through omission or providing false information. About a quarter of our cases involve private placements. So I think every state in the country can proceed. Nuala, would you feel the same way?
Oh, yes, definitely call your state regulator to tell them about the issue. We get the same types of calls. And if you are investing yourself, you know, as Jason said, when you decide to invest in a particular product, be sure you understand what you're investing in. Make sure you know who you're doing business with. Make sure you know where your money is going, what fees you're going to have to pay, and to whom that you're paying those fees. And most importantly, how can you get your money back? Those are questions that you need to, look into upfront before you put your money in that particular thing. And if you do still, invest and something goes wrong, definitely pick up the phone and call your state regulator. You can go to NASAA's website. All the phone numbers are listed there for every state, and we will help you.
Okay. Well, echo that calling your state is incredibly powerful first step, and should be your first call. And if you feel that you need to call others, FINRA is happy to take the call. The SEC will take the call. We cross collaborate and share information and make sure, I think we've done a lot to make sure that there's no wrong door in this space, and we want to collaborate and work together. So the last question I'll add that Nuala mentioned, things you should ask yourself: what could go wrong, and what if I lose my money? And just make sure that you're having some contingency, or at least considering those scenarios.
Okay, I'll move on to the next part of this. There was several questions that related to, there are people on this webinar who do use financial advisors or are considering using a financial advisor, and there were questions about the importance or significance of designations and broker check, what it does provide and what it doesn't provide. And so, what advisor designations should an individual look for in an investment and financial advisor? That's just a general question. Another person asked what financial advisor designation requires an advisor to represent the client's best interests and not only be obligated to provide investments that are suitable for them. And then the third part of this question deals with broker check. There's a statement that broker check does not cover or provide information about insurance agents who are out there selling annuity products that are not securities. And why isn't there a place that people can go to, or is there? Why isn't there a one-stop shop for where people can go to find out background information about not only stockbrokers, but people who sell products that look very much like investments but are not securities? So,
well, I will start with a pitch for NASAA in regards to the credentials. NASAA has an advisory on what all the different credentials mean, and that's available at the NASAA website, NASA with 2 A's, not the rocket scientist.org, and it's available for anybody that's interested, and it spells out what the requirements are, what the credentials are, the education and so forth for each of those different credentials.
And I'll add,
go ahead.
Sherry. I was just going to add that with credentials, yes, definitely do your research, because there are, the last time I checked, there were almost 300 different types of credentials that are out there that people can get. So it's very important that you understand what those letters mean by that person's name. And so definitely do your research. And as Lynn said, NASA has that place where you can go check it all out.
In addition, FINRA has the professional designations database where you can look up all of those designations as well. We maintain it constantly. We reach out to the sponsoring organizations to understand what the rigor is and what the requirements are. And another consideration that on top of what Lynn and Nuala suggested is to make sure that there's some sort of recourse associated with that designation. If you're going to rely on a designation, you need to also understand what is the recourse if something happens with this designant. And so in addition to, of course, what's the rigor, what kind of professional development and ongoing continuing education is required, or was it a weekend webinar and you could put up a shingle with those letters? So what's behind the designation, I think, is what we're all saying there. And Jason, if you'd like me to go ahead and answer the broker check question, I will, since I'm talking. Broker check, as you pointed out, as I've mentioned previously, includes the disciplinary and registration records for all broker dealers that are registered, all firms and individuals that are registered with FINRA. We also have historical access, so if someone's been barred, suspended from the industry, those records are in there as well. We do not have insurance agents, which you've referenced in the question, unless they are separately registered to sell securities products. And so if they are representing investments or securities, they do need to be registered to do so. But FINRA doesn't have any jurisdiction over insurance, and insurance is regulated at the state level, and there's not a single national regulator for insurance. There is an association that works with all the insurance commissions. And so really, when you're talking about an insurance agent, you should contact your state insurance commission. And sometimes that's affiliated with the state securities regulator. And Nuala and Lynn could weigh in here. And sometimes it's a separate state body, state government agency. So that's who you need to contact if you'd like to check out an insurance agent in your state.
And I can add a little bit to that. My agency is the Commissioner of Securities and Insurance. So we do insurance here as well. And Montana also considers certain annuities as securities. So those individuals have securities license. I think 17 states are similar to Montana. But the NAIC runs a database. It's called SBS. And if you call your state securities regulator, they can look up the agent. And if they're in SBS, they can share similar information to you that you can get through broker check. It's going to take a phone call. There's not a one-stop place to go in and plug the information in like with FINRA, but it's available to you by simply calling your state insurance regulator.
And Georgia's like, Montana, only in that, the insurance commissioner is a different agency. However, because these individuals seem to wear both hats, selling both products, we work very closely with our insurance commissioner's office. And when we see things, we work with them, talk to them about it, and vice versa.
Okay, so I have. We'll do one more question. We've already run over time, but the questions are really good, so I'm trying to get as much in as we can. This is a softball question. It's what efforts are there in place for state and federal governments to help citizens become informed, educated investors? I thought one of you may have put that question in there.
Georgia, I'm sure other states, but I can tell you for Georgia, we've been doing, especially during COVID, a lot of teletown halls. And we've done, I think, 6 going on 7 now. We've partnered with the SEC and the FTC and the U.S. Attorney's Office, and did 2 different town halls on the scams that are out there during this time period and what you can do, to protect yourself. And then we did through the SHELEADS programs with various people who are professionals in the investing world on how you can, protect and manage, your money and your wealth during this time. And so that's just some of the stuff that we're doing, but we also put out alerts and everything on our website. Lynn, I know Montana's doing stuff too.
Yeah, here in Montana, we physically get in a car because we have no direct flights anywhere within the state. And we drive corner to corner to corner to corner. We put on about 6,000 miles twice a year, going to every small town and the 8 cities Montana has, reaching out to investors. As the NASAA Investor Education Section Chair, in May, we put on a webcast. We did it in partnership with FINRA and with the SEC, teaching securities administrators and investor education staff on how they can reach out and reach investors virtually, because right now everything's on hold. We have to social distance, we have to wear our masks, but we're being very creative and doing everything we can because we found that the informed investor is the best tool to protect against investor fraud. So believe me, we are doing what we can, and I'm sure Christine will echo that.
Absolutely echo, ditto, I guess I should say. It's really a multimodal strategy, right? Where we have syndicated content in Yahoo Finance and NASDAQ and Motley Fool at FINRA.org. We collaborate closely with NASAA and with the SEC on alerts and other outreach. FINRA does have 2 virtual investor forums coming up in 2 weeks, so I'll go ahead and announce them. If any of you on the line happen to be in Nevada, we on August 26th are having an investor forum for Nevadans, featuring Senator Cortez Masto, FINRA CEO and President Robert Cook, and others, and Aaron Houston from the Nevada Securities Division. So FINRA.org/Nevada Forum. And then we have the same thing happening the night before in Arkansas with with another congressional representative. I'm not sure who off the top of my head, but I'm not in on that one. But we do have another forum happening, and also with the state regulator there. It's August 25th, and it is finra.org/Arkansas Forum.
Okay. Do we have time for one more? I want to ask Charles. Someone asked one question here, and then we can end. But it's pertinent to what this whole thing is about, and dealing with these tough times we've got. But the question is, it says, when times are tough, like now with many on furlough or completely out of a job, how does a person do financial triage in terms of prioritizing paying bills, cutting costs, reducing debt? What just generally speaking should come first? What gets put on hold, and what tips do you have for reevaluating your financial condition given what's going on right now? Charles?
Yeah, sure, and that's a tough situation I don't wish on anybody. I think you have to attack it multifaceted. Obviously, the things that come first is obviously making sure that you keep your housing, you have food on the table, your medications. And certainly, I think anyone in that situation, get on the phone and just start talking to your bank if you have a mortgage, or your landlord if you're renting. Let them know your situation. Same thing with credit cards. In terms of cutting, look around at what can you reasonably cut. You're capable. Maybe you can cut some services there. Obviously, you're not going to eat out as much, but you really need to attack it. I think one of the big things is if you're in a crisis, and we've seen this in many situations, but if you come across a crisis, before you do anything, just stop and just write down and think through the various scenarios you need to address and have that plan. I've been developing our AAII plan for investing, but in this situation, it's the same type of thing. Write down what you need to do and start thinking about what can I do in this instance. And even though everything's really immediate, the reality is you don't have to do everything this second. You can stop and take a day or two and think about, who do I need to contact? Where can I get maybe some leniency on paying bills? What can I tap? Where can I cut spending? And obviously, it may mean that your savings plans are going to be thrown off rail. And if that's the case, start having a plan for when you're able to get back on your own 2 feet. Start seeing your salary come back in. Thinking about, first of all, replenishing your emergency savings, and that's why you have them. We talked earlier about low interest rates. The reason why you bear low interest rates right now in your savings account is for when you do have situations like this, you do have that buffer, so you're not touching your retirement assets. But again, start just having that plan of what you need to triage should things get worse or last longer than you expect, but also have that plan for as you come out of it, do it. But I think it also just comes down to try to communicate as many people as you can, your lenders, your creditors, if you're renting with your landlord, about what you can possibly get some leniency on, and start triaging where you could possibly need help on and what you don't have leniency that you absolutely have to address. So it's not one single solution, but I do think if you just stop and start working on a plan, you start realizing there's things you can do to get help.
Thank you so much. Okay, we have to end it there. We want to thank the American Association of Individual Investors for hosting us this evening. The Alliance for Investor Education is also pleased to collaborate on investor education initiatives with our members, and AAII is certainly one of them, and an important one. If you would like to learn more about the Alliance for Investor Education, please visit investoreducation.org and follow us on social media. Now over to Ryan with AAII to discuss some other upcoming webinars. Thank you so much.
Thank you, everybody. I wanted to thank all of the panelists for joining us tonight. And if you're interested in watching more of our webinars, we are broadcasting every week, every Wednesday, typically around 7:30 Central. Next week, we are featuring a webinar starring our own AI analyst, Wayne Thorpe, on investing like a stock superstar, a contrarian approach to seeking fundamental growth. Join us for that one on August 12th. The following week, we have a AI panel of all our analysts unveiling AI's Platinum service, our new package of what AI offers in terms of investor education, all in one bundle. Join us for that webinar on August 19th. And sorry for this last slide, but the last one, but Charles is actually going to be, sorry, if you could go back, Whitney, sorry. For the last webinar in August, Charles is doing another webinar on the AAII way, which is titled A Sample Investing Plan Based on the AAII Way. It's just an update on a new financial plan that he is building as part of AAII and that you can follow along to build your own kind of personal investing plan. Join us for that webinar on August 26th. Thank you so much, everybody, for joining tonight's webinar. We hope that you stay safe, stay home, and I echo everybody else's sentiments here. Invest wisely and invest carefully. Thank you so much. Good night.